So what's an assertion in auditing? An assertion is just something that management wants the readers of the financial statements to believe. Because whenever anyone opens their mouth, they're asserting themselves. And what they're saying is an assertion. And what management's saying about the financial statements are certain assertions. For example, when management produces the financial statements, they're responsible for the financial statements. And in those statements, they're making all kinds of assertions about the items listed on the financial statements. One of the things they're saying is that the financial statements are complete, that nothing's missing. Another thing they're saying is that everything that's in the financial statements really did happen, that they didn't make anything up and pretend that something happened, in which case you'd have overstatement of things like revenue, which is presumed in every audit. So some of our assertions are going to include testing for overstatement and understatement. Completeness would be a test. Completeness would be management's assertion that everything that should have been recorded have been recorded. So we're going to get into the assertions, but for now, let me give you an example of why this is important on slide 3. In producing financial statements, management makes assertions regarding things like recognition, that they recognized everything in the proper period, that they measured everything accurately, that everything's presented the right way and disclosed. For example, accounts receivable is listed as $10 million. Well, management's making assertions with that accounts receivable exists, that there's no fake or fictitious customers, right? Because if there were a bunch of fake customers within that accounts receivable balance, then that would impact the existence of those receivables.
Correct.
So there's a risk that the accounts receivable is full of fake customers, and the management, when they make the financial statements and when they show the accounts receivable as $10 million, one assertion is that all the customers are real. Existence would be the assertion in question there, because management wants us to believe that all customers exist, that all the receivables exist. But we're not just going to believe that. We're going to have to design audit procedures to make sure that all customers exist. And if you remember, one of the things we're going to do is to send confirmations out to customers.
And that would be existence.
Right, and that would try to prove existence, exactly. So with accounts receivable, we know that there's an assertion known as existence. But there are other assertions with regard to this one account known as accounts receivable. Every account impacts more than one assertion. So accounts receivable is going to impact more than just existence of receivables. So when management says accounts receivable is 10 million, existence is a big issue here, but it's not the only one. It's not the only one. Existence of receivables is paramount, but there's another one. What about valuation of receivables? What if the receivable balance doesn't really add up to 10 million, but all customers are real, none are fake? You see how maybe they satisfy existence because all the customers are real, none are fake. But when we send out the confirms, what we're finding is not fake customers. We're finding that the customers really don't owe as much as the company indicated, as much as our client indicated that they owed. And that wouldn't impact existence of receivables. It would impact valuation of receivables.
That makes sense.
Because accounts receivable wouldn't be properly valued, whereas the client is asserting that it is properly valued. So valuation is another assertion with regard to accounts receivable, that all receivables are properly valued. Now, of course, completeness might come to also, but we're not really thinking that the client is going to deliberately understate receivables. So they're making an assertion that all receivables are complete. That means whatever receivables should have been recorded were. And we don't think that they're likely to understate receivables. So while we will test these assertions, we're going to test them in accordance with risk. And there's really not that much risk to us that the client's going to understate receivables. So we're not all that interested in completeness of receivables. But existence, yes, there's a big chance that receivables are overstated. Not much chance that they're understated.
Okay.
And valuation, sure. There's a chance that these receivables are overvalued. What's one way to know that receivables are overvalued? If we look at the aging schedule and we find that these receivables have been on the books for a year and a half, 2 years, we know that the receivables are overvalued. Maybe the customers are real, but doesn't look like they have a lot of intention of paying.
That makes sense.
So valuation deals with how likely we are to get paid from a receivable, whereas existence deals with, is the customer fake or are they real? And they'll ask you about that. How does the auditor gain satisfaction with regard to valuation? We know how we're going to do it with regard to existence. We're going to send out those confirmations. That'll satisfy existence, but that's not going to satisfy valuation of receivables just by sending out confirmations, because confirmations won't tell us when those customers are likely to pay. So if we want to know about payment, we can't just send out a confirmation. We have to be a little bit more aware of what testing to do for valuation. And how are we going to test valuation? Well, there's an aging schedule, right? We'll look at the aging schedule. We'll see how old the receivables are. The oldest ones, we're probably going to have to encourage the client to write them off if they're really old, right? If they're particularly old, we're going to have to encourage them to write them off. All right, and then there's another assertion with regard to accounts receivable. So three big ones. The third one would be rights and obligations, because there is a risk that the client already assigned the right to collect those receivables and didn't indicate that. So that's another assertion with regard to receivables. Rights and obligations. Because if they pledge the receivables, let's say for collateral of a loan, then the client doesn't have any more rights to those receivables. So there's three assertions right there, and you can add completeness to that, but we're not really that interested in completeness of receivables because they're less likely to understate receivables. They're very likely to understate payables. So when we get to payables, we're going to be interested in completeness. But with receivables, they're more likely to overstate them than understate them, right?
Yeah.
Okay, let's go to 4. CPA's use of management's assertions. Management makes the assertions, but the CPA will use the assertions to form a basis for things like the assessment of risk of material misstatement and the design and performance of what we call further audit procedures. So when the CPA uses these assertions, the whole idea is we're doing it because we want to know what to do next. So if we're interested in the fact that some customers might be fake, what do we do about it? We have to send out confirmations. If that's our concern, existence of receivables, what do we do about it? We have to send out confirmations. If our concern is overvalued receivables, what do we do about it?
Then overvalued would be, that's like the valuation. So you'd be looking at an aging schedule?
That's right.
Confirm that?
Yep.
Okay. Oh, this is coming together. Okay.
And the design and performance of these further audit procedures, the outcome of the CPA's evaluation of management's assertions, will lead to either more testing or less testing, depending on our procedures.
Okay.
All right, so number 5, the CPA uses the assertions made by management to what?
To Both.
Yes, correct. Okay. All right, go to 8. Now, the assertions used by the auditor can be classified into 3 categories. We have assertions about classes of transactions and events. We're talking income statement assertions, mostly focusing on sales and purchases, because there's assertions that deal with the income statement, and there's assertions that deal with the balance sheet, and some of them overlap. You might find some assertions that deal with the income statement that also deal with the balance sheet, but you're going to have some unique assertions when it comes to the income statement that only deal with the income statement. For example, cutoff will be an income statement assertion. You won't find that about balance sheet accounts because the sale either happened in this year or it happened in the subsequent period. It either happened in the year under audit or it didn't happen until the next year. So cutoff is about the income statement. And then there's assertions about the balance sheet that are unique to the balance sheet. For example, rights and obligations. Rights and obligations is only for balance sheet accounts. Rights to assets and obligations to pay liabilities. Nothing about the income statement there. But just about all the other assertions, completeness, existence, occurrence, valuation, will apply to both the income statement and the balance sheet. So let's start with the income statement and see what's unique about income statement assertions. Go to 16.
Okay.
Assertions about classes of transactions and events. The income statement assertions. The first one up is completeness. The assertion here the client is making with regard to the income statement is that all transactions and events that should be reported on the income statement have been reported on the income statement. All the sales, all the expenses, everything that should have been reported has been. That's the assertion known as completeness. Now, if any have not been recorded, then the books are not complete. So with completeness, our concern as an auditor is always the same. Our concern is always understatement with regard to completeness. We're always concerned with understatement. We're concerned as an auditor that the client understated something. Maybe they understated purchases. Maybe they understated something on the income statement. That's the whole idea with completeness. So we've got to design auditing procedures to make sure that transactions that should have been recorded have been recorded. And one of the things we're going to do is cutoff test. Cutoff tests, we said, are unique to the income statement. Not going to go over that now. We'll do that when we get to the cycles. When we do the revenue cycle, we'll get into a cutoff test.
Oh, perfect.
And the same thing with purchases. Go to 17. With the completeness assertion, the auditor is concerned that some purchases that were made at the end of this year were not recorded. And this would cause the books to not be complete. The concern will be understatement of purchases and the related accounts payable. So to test for this, the auditor would perform cutoff tests to see if any purchases were left off the book. So the first assertion out of the box under the category of the income statement is completeness, but by no means is that the last one. Just the first one. And it doesn't have to be in any order, but that is a very important one. Where the client is asserting what with regard to completeness? What's the client's assertion?
That the financial statements are complete.
Right, that everything that should have been recorded on the income statement has been.
Okay.
And if anything hasn't, then the books aren't complete. And cutoff testing would be done to test for completeness. Now let's go on to 18 and look at occurrence, the second assertion with regard to the income statement. Occurrence of sales, particularly sales. The auditor would be very interested in completeness with regard to sales. Why?
Okay.
I'm sorry, occurrence with regard to sales.
Occurrence.
The auditor would be very, very seriously, aware of occurrence, because in every audit, there's a presumption of overstatement of revenue.
Okay.
Every audit, there's a presumption of overstatement of revenue. So that means the easiest way for the client to cook the books is to overstate sales, right?
Mm-hmm.
All they got to do is overstate sales, and they've effectively overstated net income, haven't they?
Yes, correct.
So occurrence with regard to sales is where the client is suggesting that every sale that's on the income statement really did occur in the period under audit. That's occurrence. The concern is overstatement as opposed to understatement.
Okay.
For if the client recorded something that has not occurred or has not occurred yet, they've overstated. In this case, revenue. Did the sale occur? Did it occur yet? We want to make sure as auditors that we can design audit procedures to make sure that any transaction that's been recorded really did occur. It's the opposite concern of completeness for us.
Mm-hmm.
With occurrence, we're concerned that anything that was recorded as a sale really did occur and really was a sale in the year that they recorded it. And they didn't record it too early, or they didn't cook the books and record something that never happened. So look at 19. With the occurrence assertion, the auditor is concerned that certain transactions that have already been recorded did not occur yet, or didn't occur at all, and never will. The concern is overstatement in that the company is merely cooking the books, recording sales before they happen.
Okay.
To test for this, the auditor would perform cutoff tests to see if any sales were recorded early, before the earnings process was completed. So the first two assertions out of the box in the income statement are what?
Occurrence and completeness.
Right. And here comes the link to both of them. Cutoff.
Okay.
Cutoff is an assertion of its own under the income statement, which links completeness and occurrence together. Because with cutoff, here's where the company is asserting that December 31st is the cutoff date. That any sales that actually took place after December 31st were recorded in the subsequent year, and anything that occurred before December 31st was recorded in the year under audit. That's the cutoff assertion.
Okay. Okay.
Transactions and events have been recorded in the correct accounting period. And cutoff, we know, is linked with understate and overstate as a result. So that's the third assertion with regard to the income statement. So really, those three go together. Completeness, occurrence, cutoff. Those three go together.
Mm-hmm. Okay.
Then the last two, one being accuracy and valuation down there, and one being classification and understandability, those two go together. Looks like four, but really there's two. Classification and understandability is one, and accuracy and valuation is the other. These two are linked together, and you'll see why. Because classification is where the client is asserting that any account, that the transactions and events have been recorded in the proper accounts For example, if something was insurance expense, we didn't call it repairs and maintenance expense.
Okay.
And if something was repair and maintenance expense, we didn't capitalize it. Everything was recorded in the right account. That's classification and understandability. It was classified properly. If it's a sales return, the company used that contra account and didn't just debit sales. That's classification. You with me?
Okay. Yeah.
They used the right account to record
Okay.
the transaction. Then flip to accuracy and valuation takes it a step further. They recorded
What's
it not
that?
only in the right account, but for the right amount. It's one thing to record something in the right account. It's another thing to record it in the right account at the right amount.
Okay.
And the client's asserting they're doing all of the above. That they're recording it in the right account and for the right amount. Accuracy and valuation means the right amount. Classification and understandability has to do with the right account.
Okay.
So in the end, on slide 21, we have the income statement assertions with an acronym COCA. I think Becker uses a different acronym. I think Becker uses cover you as an acronym for all assertions. But the problem is all assertions are not created equal.
Yeah.
Some are income statement assertions you have to know. Some are balance sheet assertions only you have to know. So that's why I categorize them the way they are really categorized. Becker kind of abandons the categories and just has cover you.
Okay. No,
So whatever helps you, but I think this will help even more.
This is good. Yeah. Yeah.
So on 20, this is one of the toughest parts of auditing to do, is this session right here, and then going into the cycles. It's a lot easier to go through the risk and the planning and even reporting. This is the toughest part. So like on my first day with audit, with a new audit student, I would never do this chapter, but you got a 74 last time, you said, right?
Yeah, 73.
73. This is what you need to go over.
Yeah. No, I agree.
Because this is what cost you 5 to 10 points. Just assertions and two-directional testing.
Exactly.
That kind of thing. You would have passed with that. So that's really all we're going to do. And that's, I'd say 50% of my audit students, that's all I do with them is the transaction cycles and the assertions. That's it.
Yeah. That makes sense. It's funny too, because like in your job, you don't focus on this.
No, probably not. Yeah. Well, the rare student that comes to me having no audit background, then we do more. But we go through Sarbanes and independence rules and all that. But you're probably fine with that.
Yeah. No, I am.
We could do some sims at the end maybe with that, but not going to waste any time here. Let's go to 22. Which of the following is a financial statement assertion regarding classes of transactions?
Both, because they're both an income statement.
Yes, that's right. Both completeness and occurrence. Completeness, the client's asserting what? Everything that
that happened was recorded.
Right. Everything that should have been recorded, everything that happened was recorded. And with occurrence, what are they asserting?
That everything that occurred has been recorded, and that like pertains to the company.
Right. Everything that has been recorded really did occur.
Sure.
Right. All right. Let's go down now to 29 and say the cutoff assertion has a direct impact on which other assertion?
With both completeness and occurrence?
Yeah, the cutoff has a direct impact on completeness. What about classification?
No.
Nah,
It was
classification's totally
completeness and
different.
occurrence.
Right.
Okay.
Cutoff's only about completeness and occurrence. Right. That's 32. The cutoff assertion has a direct impact on which other assertion?
Occurrence.
Completeness and occurrence, right?
Occurrence.
Both. Okay. All right, now let's go from the income statement assertions to the balance sheet assertions. You ready?
Yep.
All right, so now we're going to look at assertion category known as assertions about account balances at the end of the period, known as balance sheet assertions. CREV is my acronym for the balance sheet assertions, and I stuck them all on slide 36. Maybe I shouldn't have. It's kind of makes it hard to see, but it allows you to memorize CREV.
Okay.
All right, and completeness appears for the second time. We had it under the income statement. Here it is again under the balance sheet, and it means the same thing. It means that the client's asserting that all assets, liabilities, and equity this time that should be presented in the balance sheet are so included. Everything that should have been recorded as an asset, liability, or equity was recorded as an asset, liability, or equity. Nothing was left out. The books are complete. That's what the client's asserting. We're going to have to design tests to make sure. And when we get to the cycles, whether it's revenue cycle, expenditure cycle, inventory, we'll see what tests we're going to do to test for understate and overstate with regard to the balance sheet.
Okay.
Then we see that occurrence appears for the second time in red down there. But when it appears with its kissing cousin, existence.
Okay.
Existence and occurrence are very closely related. You often see them together in an answer choice on a CPA exam in a multiple choice question. You'll see existence slash occurrence. So what's the difference between them? Nothing really. Technically, it's only that existence is a balance sheet assertion. That means the same thing as occurrence under the income statement. Why do you need both?
Okay.
Well, technically again, under the income statement, we said a sale either occurred this period or didn't occur yet, right? Sales don't really exist. They either occur or they haven't occurred yet. Whereas assets and liabilities, they exist. They don't occur, right?
That makes a lot of sense.
So that's why you see both existence slash occurrence, but they both mean the same thing. The client's asserting what?
That like the whatever happened during the period was recorded.
That's completeness.
Oops, so occurrence would be that
existence slash
that everything that
occurrence. The client's asserting what?
That everything that is recorded actually happened.
That's right. Everything that was recorded as an asset really does exist as an asset at year end. For example, receivables. If you have a receivable that's recorded at year end, the client's asserting that that customer what? Exists. Is real. Isn't fake. That's the existence assertion. Well, isn't it the same as occurrence? Client's asserting that everything that was recorded really did happen? Sure, it's exactly the same, except that with existence, we're referring to assets, liabilities, and equity. With occurrence, we're referring to revenues and expenses. But it's the same idea. The client's asserting with both existence and occurrence that everything that was recorded really did happen, occur, income statement, or really did exist, balance sheet, at year end. That's why I call existence, occurrence kissing cousins, because they are that close. And
that makes a lot of
sense. You often see them together. You often see them together as an answer choice in a multiple choice question on a CPA exam. And the answer would be existence, occurrence if they were asking you about the auditor being concerned with overstatement. If the auditor is concerned about overstatement of sales, it would be occurrence assertion. Overstatement of receivables, it would be existence assertion. we know that the receivable and the sale go together, don't they? Because if you have a sale, the entry is debit accounts receivable, credit sales. The receivable is your existence. The sale is occurrence. They go together. And the auditor would be
Okay.
just as concerned with the occurrence as with the existence, the fact that that transaction may never have happened. In which case, if the sale never occurred, the receivable doesn't exist.
Okay.
All right, so we've seen completeness, we've seen existence, occurrence twice. The income statement had completeness, the income statement had occurrence, the balance sheet has completeness, the balance sheet has existence. What about valuation down there? Valuation, assertions about valuation of assets and liabilities deal with whether these assets, liabilities, and equity interests have been included in the financial statements at their appropriate amounts. Inventory at the lower of cost or market. Accounts receivable at net realizable value. That's valuation. You'll always know, I want you to write down, you'll always know that the correct answer to an assertion question is valuation.
Okay.
You'll always know that the right answer is valuation assertion when the exam asks you about the contra asset rather than the asset itself. How does that work? Well, if the question says the auditor is examining the accumulated depreciation account,
Okay.
what assertions impacted? Valuation, because that's the contra asset. And
Okay.
anytime the auditor is focused on the contra asset, the answer is valuation, not existence. The
That makes
wrong
sense.
answer would be existence if the auditor is focusing in on the contra asset. If the auditor is focusing in on the allowance for doubtful accounts with respect to accounts receivable, the answer, what assertions impacted? Valuation,
Got
not existence. So it's always valuation is the right answer when the auditor is focused on the contra asset. All right, so 37, I just threw you a nice softball here. The auditor is gathering evidence regarding the accumulated depreciation of fixed assets. What assertion is being impacted?
Valuation.
That's
It's
how
a
it would look.
contra.
That's how it would look.
Okay.
Now, would you have got that question right 20 minutes ago?
No.
You would have probably been torn between existence and valuation
Yeah.
because you know fixed assets, right? That's an asset. Maybe it doesn't exist. I don't know. What am I being asked here? Well, if they're focusing you on the accumulated depreciation, then you know it's a contra asset. That's got to be the valuation assertion.
Okay.
All right, go to 39. Hope you enjoyed that video on audit assertions for the CPA exam. For more CPA exam video lessons and simulations, visit cpaexamtutoring.com. Also check eBay for weekly video specials from CPA Exam Tutoring.